It's safe to say that 2022 has been a pretty slow year for EV stocks as we see Nio and Xpeng Motors both underperform the Russell 2000 small cap index by a very decent margin. Last year it looked like the growth stock destruction might only hit the pre-revenue and highly speculative EV stocks only, but now in 2022 we're seeing established leaders like Xpeng and Nio also get hit big time. And with the February delivery numbers now out, it seems like competitors like Li Auto have gained a lot of market share in China while having outperformed both Nio and Xpeng's share price. So in this video, I'll compare the delivery numbers for all three of these EV giants, share the latest developments behind a potential Chinese recession, and at the end I'll analyze the stock charts to get an idea for whether it's worth buying this dip on both Nio and Xpeng. But before we get into it guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. Let's start off by addressing the big news that came out over the past few weeks, which are the February delivery numbers for basically every single Chinese EV company, which is typically expected to always be very slow because of obviously the Chinese holiday season. And so it's no surprise that companies like Nio and Xpeng have seen some sort of decline from their January to February numbers, but overall I see a lot of sentiment being excessively fearful around these Chinese EV companies. On the surface, yes, a company like Nio reported a 10% increase in the number of cars delivered in 2022 as compared to the cars it delivered in 2021, and that is certainly a decline from the growth that this company experienced in January of this year. And yes, even a much faster growing EV company's deliveries like Xpeng's have also gone down and cut in half in February as compared to January. But the big problem that the media is not really addressing is the fact that the Chinese economy has slowed down significantly since the fall of last year. And since February is typically a holiday season for the Chinese economy, there are a lot of deliveries that are not going to be occurring during this specific time frame. And if you pair that with the fact that Omicron hit China very hard at the end of last year and is still somewhat hitting the Chinese economy very strongly because of lockdowns and very sincere and strict rules, it's very easy to see why delivery numbers for both of these Chinese EV companies have come down. As you guys can see, over the past 3 years, historically the start of the year has always been a very slow time for EV sales, and this sales slump has not just been restricted to Nio and Xpeng, but we've also seen this happen for BYD, which is one of the biggest EV makers across China. And yet another massive headwind that has pushed back a lot of Chinese sales is the fact that China cut a lot of their incentives at the end of last year. And because of that, a lot of people likely rushed into buying their EVs in December, and that definitely suppressed a lot of the January and February data for these companies. And historically, looking at the month-to-month data just does not make sense because there are a lot of seasonalities that investors need to account for when you're comparing month to month. As you guys can see, year over year, a company like Xpeng has grown its deliveries by around 180%. And what I really like here is the fact that Xpeng took advantage of the downtime in February to retool one of its plants to increase its production capacity, which again is going to play very well as we see sales increase going into the end of this year. And if you compare the February data to their January data, Xpeng has actually accelerated its growth as they grew by around 150% year over year last month, and now they're obviously growing deliveries by 180%. Whereas for Nio, the situation is a little bit more dire because in February they grew deliveries by around 10%, but in January they actually grew deliveries by around 31%, which signals that this company is definitely facing some problems when it comes to selling their more expensive SUVs so far, which might be attributed to the Omicron variant and some of the lower growth that we're seeing from the Chinese economy. And I would definitely attribute that slower growth to the reason why Nio has underperformed a lot of the other Chinese EV stocks, and the reason why the stock has consistently sold off every single rally that it's had over the past 6 months. But the very critical thing to keep in mind is that just because Nio or Xpeng have seen some slower growth, that does not mean that these stocks are completely out of the game when it comes to the EV mania. As you guys can see, China has overall seen a very slow growth throughout 2021 and at the beginning of 2022, primarily because this country led the growth out of the pandemic with a GDP growth of around 8%. And as you guys can see, China's share of global GDP has consistently increased over the past 10 years or so, which means that if China is hinting at some slower growth in GDP, it means that there are chances of potential fiscal stimulus being poured out in the economy by the Chinese government. And that is obviously because inflation in China is not that high right now as compared to the US, which is sitting at around 3% compared to the US's 7.2%. And because of the strength the Chinese yuan has seen as compared to some of the other currencies, and obviously the lower inflation targets in China, there's much more room for a country like China to operate more stimulus and fiscal spending into their economy to make sure that it can reach its GDP targets and it can help ease some of the global supply chains. And as you guys can see, many economists are expecting more fiscal spending and lower interest rates in the Chinese economy throughout 2022, which is going to play in the hands of consumer spending and boost growth for EV companies like Nio and Xpeng, because obviously when it's easier to get a loan, you're going to be more tempted to go out and buy an EV, which obviously is becoming much more attractive in an environment like today, where oil has become such a critical resource and prices are through the roof. And as you guys can see, China still has the dominant force when it comes to the global EV market, with around 53% of global sales in 2021, which is absolutely an insane number. And when the market itself is growing so fast, a lot of the key players in the market like Nio and Xpeng are gonna thrive regardless of poor execution in the short term. Now, obviously, we would not be able to talk about China without addressing the big elephant in the room, which is the Russia-Ukraine conflict, which I definitely think has also weighed on a lot of the Chinese EV stocks recently, because obviously there's concern that if we could be forming a Russia to China alliance, or if China somehow decides to invade Taiwan, that there could be sanctions on the economy and that would further spur a potential recession. What my take on this is that China is closely monitoring what is happening to Russia with the sanctions. And I think if there's a clear indication that the Russian economy is collapsing, which we're already seeing is starting to happen, then there's less incentive for a country like China to engage in more geopolitical uncertainty with Taiwan and potentially put its economy in a recession. Now, obviously, there could be more factors that come out that change my investment thesis around investing in China. But at least for right now, I'm cautiously optimistic that we're not going to see a further deceleration of Chinese-US relations and that the Chinese economy is able to thrive and get back to its 5.5% GDP growth. But if we factor out the geopolitical tensions and actually analyze the electric car industry in China, we can see that as of 2021, some of the best-selling vehicles in China right now are dominated by companies like BYD, Tesla, Li Auto, and obviously Xpeng. And this is very interesting because Li Auto actually went public alongside Xpeng Motors in 2020, and because of that, it has actually been sitting under the radar, even though Xpeng and Nio have gotten most of the love. But more recently, Li Auto has actually come out with a very big surprise in their deliveries, and they've been actually beating the delivery growth for both Nio and Xpeng, which puts into question a lot of investors' thesis around Li Auto as a company. But just looking at the products that Li Auto sells on the surface, I'm seeing that the main product they sell is this Li 1 SUV, which actually is a hybrid between a gas engine and a battery pack. As you guys can see, they basically have this battery pack at the bottom of the vehicle, and then they have this gas engine that they call the intelligent power generation system that essentially helps propel the battery and increase its range. As you guys can see, there's a fuel tank right here, and there's something that looks like an internal combustion engine on the left side, which gives me a hint that this car is actually a hybrid and not a fully electric vehicle. So I'm kind of surprised as to this vehicle being included in the zero emissions vehicle sector of China, but obviously we could be seeing some sort of different regulations as compared to the US that could put this car in that category. But nevertheless, I would definitely want to see some more data from Li Auto over the next couple of quarters as to their profit margins and their earnings expectations going into 2023 before I make some sort of strong decision as to whether or not this company is a real threat to Nio or Xpeng. As for which stock I've been personally buying aggressively over the past month or so, it has definitely been Xpeng Motors from both a financial perspective and a valuation perspective. As you guys can see, Xpeng has a lot of cash and basically negligible debt over the past year or so, and their revenue has definitely seen a very consistent uptrend. Now obviously their losses have gone down significantly, but that's primarily because these guys are investing rapidly in growth and bringing out new models like the G9 and obviously their $25,000 P5. And the financial situation is definitely very similar over at Nio as well, as their revenue has grown significantly over the past couple of years, and obviously their cash flows have also been significantly improved, even though their debt unfortunately has gone up a little bit more. But on the other hand, Nio has definitely kept their losses very significantly low as compared to Xpeng Motors, which is primarily because these guys have much more scale and they've been delivering cars for a longer period of time than Xpeng. If we now compare the stock charts for both, you guys can see that NIO is definitely a little bit of a better deal in terms of a technical play right now, whereas Xpeng has potentially a little bit more downside after it broke through this very recent support level at around 30 bucks and is potentially now heading down to test this support level at around $25. Whereas for NIO, it looks like the next support level for the stock is sitting around $16, which is right around the level that the stock broke out significantly back in 2020. But anyways guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below your thoughts, and I'll catch you guys in the next one. Take care.